It's Wednesday, and it's another episode of the Educated Homebuyer Live with Josh and myself. We're here to talk about the economy, talk about the Fed, answer your questions, mortgage and real estate, and help you become the educated homebuyers. Josh, welcome back. Were you here last week? You were gone last week. No, you were here.
I was
You
here.
were here.
Last
You were
week
here
was my
last
first week back.
Nice. And how does it feel to be back at work?
Stressful, Jeb. Stressful. I appreciate you asking. That was very helpful.
You know, my wife tells me that I need to communicate. I need to be more empathetic. So I want to know how you feel, Josh.
I don't feel the empathy. I feel
You
the
do not
mockery
feel
is
the empathy.
what I'm feeling.
That's fair. That is fair. Okay, guys. So this past week, what happened? Well, that's a good question. So today we got some employment numbers with regards to JOLTS. We had, numbers coming in a little bit lower than expectations, which is a sign for a slower job market, along with some revisions that push downward. With that, we've seen the 10-year move down. And we're going to talk about all of this stuff as we dive more into the charts tonight. But Josh, anything you want to lead off with before we dive into the charts that we talk about every single week?
If you're buying a home, when you get in escrow, get your insurance lined up very, very early in the process. 9 times out of 10, it's a 1, 2, 3 day thing. Sometimes it's significantly longer. We have a transaction that's supposed to close on Friday, and the borrower has an insurance quote, but the underwriting process, due to some issues between the borrower and the property, is dragging on, and we cannot send loan docs out until we have that insurance. So it may delay his closing and his ability to move over the weekend and all sorts of things. So do yourself and your loan officer a favor, remove the stress from the situation by front loading your homeowner's insurance within the first 7 to 10 days of the transaction.
There you go. Good stuff. With that, guys, we are going to dive into some charts as we do every single week, and we like to start with inventory. So inventory currently sitting at 704,000 unsold single-family homes nationwide, slightly fewer than last week, just by a little bit, less than a couple hundred. Same week last year, inventory actually rose by 1%. So is this the peak in inventory? Hard to say, but it is slowing down. Could be the holiday week that we saw last week, right? We normally see some changes in volumes and what happens during those holiday weeks. So next week will be a sign of whether or not this is a trend, if you will, or if we kind of revert back to what we've seen like last year, going up in those in the number of listings. Orange County, we actually saw listings come down this past week. We're sitting at 3,552, down just less than 1%, 0.82. Huntington Beach down at 244. That's down 3.69%. Again, is it Labor Day? Is it the market? Just seasonality slowing for the year? We need a couple more weeks to figure that out.
Is it improved affordability, Jeb?
Is it improved affordability? It's hard to say, right? So, but seasonality does play a part in these things. It's just hard to figure out whether or not we've seen the peak or if the holiday is playing with our heads a little bit. New listings. So this is a slightly different chart, but it's getting the same general information across. So new listings, 59,000 new unsold listings, plus 10,000 that went into immediate sales over the past week. 6% fewer sellers than last year. Essentially, basically what they're saying is no buyer urgency uptick in properties going under contract at the moment. Now that's going to put us into pending home sales. Actually, the week over week changes. So 704, 744 down to 704, 335. Our max for the year is 704, 744, which was last week. We're slightly below that. Again, we need some more time to figure out whether or not this is a trend or if we just revert back to the direction that we were going, which is up. Weekly new contracts pending, 64,000 new single-family homes under contract, plus 12,000 condos. That's 2.5% fewer than last week, unchanged from last year. Median price of new contracts sitting at $449,000. That's unchanged week over week and pretty much year over year. New listings, 400,000. And that's slightly up above last year. New contracts sitting at 387. That's up 5% year over year. And we've seen that with the new home sales. We've seen that market still move. We've seen those numbers come out hotter than expected. And it's partly because they can continue to buy down rates. They can do things that a lot of us, you can't really do in the existing home sales market. or I guess you can do, but we don't see a lot of it. And then percent of properties with price reduction sitting at 40.3%. So slightly higher than the last couple of weeks, but you can still see we're trending right where we were in 2022. And Josh, that takes us into year-over-year change in median condo HOA dues. So I found this chart interesting in seeing that the majority of, if you kind of look at the left side of that chart, those markets are markets where they're seeing the biggest increase in monthly HOA dues year over year. And you can look at the bottom there, Tampa, Orlando, Fort Lauderdale, Texas, parts of California. So a lot of the markets that we talk about that have had, the biggest problems with insurance and biggest problems with, inventory building outside of California is in that condo, when talking about condos, and a lot of those are in the markets that we often talk about. On the flip side of that, Pennsylvania, Montgomery County, and then I can't read what the small one is there, Josh, that Austin, Texas. Actually saw a pullback in HOAs, which is quite surprising. And I don't know if has anything to do with the number of them hitting the market or what.
Well, in Montgomery County, apparently there's one condo complex and they dropped their HOA dues 10% this year.
Exactly. It could very well be the case. Among the 300 largest market, condo values are up the most year over year. And look at Connecticut. I mean, Connecticut is going crazy, right? So when we talk about, the markets that are still doing really well, the markets that are still seeing that craziness that we saw a couple of years ago, we've talked about the Northeast. I mean, there it is, right? Atlantic City, and then essentially the entire state of Connecticut is going bananas, at least when it comes to condo values. And then if we look on the flip side, the condo values that are down the most, Louisiana, Florida, Texas, Tennessee. So Tennessee's kind of the one that's not down there in the South, if you will, or around the Gulf there, where we've seen a lot of inventory build and we've seen the market slow. But anyway, taking us into PCE. So Josh, we had PCE last Friday, which came in it came in right in line, right? Came in right in line with expectations. And here we are.
Right in line. And if you look at the unrounded numbers, they were a little bit better, but it was pretty much as expected. So the market took it with a grain of salt. It wasn't bad. It wasn't a positive surprise, but it was there in line. But if you look at these charts, you can see a very clear downtrend, change in real personal spending month over month, which is part of that PCE information. The core PCE on a 3-month annualized basis, absolutely trending down. So in terms of Fed cut expectations, didn't really alter anything. Didn't make them think less of cutting. So, and it also didn't lead to answering that question of 25 or 50 basis points. So today, or this week, really is all about jobs. Jeb, we got 4 important jobs reports that all come this week. We had JOLTS today. We get ADP tomorrow. It's usually on Wednesday, but delayed by the holiday. We get the weekly claims comes tomorrow. And then Friday, we get the August report of the first Friday here in September. So the first one we got today was actually a pretty big downside surprise. If you look at that, it's the lowest level, least job openings posted since July, 7.7, at least since 2020, basically prior to the pandemic. So there's a portion of this, Jeb, there's some theories floating about that once we got the work from home stuff and remote jobs, a lot of these jobs were getting posted in multiple places. A job that you can work from home, they would put it in basically any market where they thought there was a worker pool. So there's some of that moderating, but definitely we can see here layoffs rose to 1.76 million, the highest level since 2023. So none of this is super negative. It basically means that we have a job opening for everyone that is unemployed. So when you look at this open jobs for unemployed worker, at one point there were 2 jobs for every unemployed worker. So that worker had a lot of power and leverage, which in reality and in theory was going to lead to much higher wage-based inflation. So even though we're talking a lot about jobs and jobs data, it truly just leads back to inflation. So this biggest drop since early 2021, you can see on this longer chart goes a decreasing trend. And then the level of layoffs is an increasing trend. And that little circle in the red, you can see a pretty big spike up here. Employers have been very slow to lay off workers because it's been a tight jobs market. They don't want to have to hire people back and have to hire in at higher wages. Keeping an employee is cheaper than going out and getting a new one. So, Jeb, we get on Friday, I didn't really throw any data in there. The expectations are for Friday for that jobs report that we're going to see some continuing weakening. But we've talked before about the two surveys, the household survey and the establishment survey. We saw unemployment reported at 4.3% last month. 4.2% is the expectation. If we're somewhere 4.2, 4.3, probably not going to move the market. If we get at 4.4, 4.5, it's going to ratchet up thoughts or hopes or expectations that the Fed may cut 50 basis points. Now, before that Fed meeting, flashing forward to next week, we will get CPI data. And when we look at that, this is that nowcast for what, I forget which, is it the Richmond Fed that does this? I forget who does it, Jeb, but they're expecting 0.2 month over month on CPI, 0.26 on core CPI. So what do we have on the core? We got a 0.50 falling off and a 0.26 coming on. So the core is probably going to look better. Now, when we look at actually the headline, so the core at 0.23. So with that, again, it's likely to show this slow and steady, moderate improvement moving forward, not likely to be anything earth shaking. So I thought I would throw this in, Jeb. People in America, we think we're the center of the universe and that everything is terrible here and things are impacting us. This is a nice little chart that shows cumulative real GDP growth and core inflation in advanced economies. So where you want to be is at the bottom right. So you're having a nice amount of GDP growth and you're having low inflation. So we're kind of middle of the road in terms of inflation of all these major industrial economies, but we definitely have the most growth of all of those. So it could be worse. We could have low growth and high inflation. This is another chart that kind of goes as we're in election season here and people are thinking, talking, worrying about how people are going to vote and what issues are impacting voters. This is a chart that actually shows real wage growth across the wage distribution. So we've got 1, 2, 3, 4, 5 separate percentiles of wage earners. The lowest wage earners had the highest real wage growth. So we've seen this. Fast food workers, many people on the low end of the spectrum saw the biggest wage increases. They also still are most impacted by the effects of inflation, but in real terms, they have more buying power than they did before the pandemic. Now, what we see here is the highest voting group is this middle wage and upper middle wage group, and they have seen the least benefit in real terms. They're still in real terms making more post-COVID with higher wages, higher inflation. They still have more money to spend, but that probably goes a long way towards explaining a lot of these surveys where people think the economy is a little bit worse than it is actually performed, but that may also just be expectations of where they think it is going. So big picture, we are still now, 14 days, two weeks out from Fed Day, almost 50-50. It's 55-45 as to whether they cut 25 or 50 basis points. That jobs data the rest of the week, Thursday and Friday, and the CPI data next week is going to go a long ways towards dictating that. But right now,
yeah, with that said, I mean, that 45 last week was 34 or something, right? So the percentage is going higher on the number of people thinking that the bet's going to be a little bit higher, or the cut rather.
And flash forward to November, Jeb, the November one's the real interesting one. It's a 50% chance that we're 75 basis points lower. So that whether we get the 50 here or the 50 at the next meeting, that's a 50% chance that, 32% chance that we get 2 quarter point cuts, 50% chance that we get a quarter and a half, and then we got an 18% chance that we get 2 half-point cuts. We would have to see some serious weakening of the data to see that, but the market is saying there is a possibility of seeing that right now. So flash back to the wonderful candlesticks. Jeb, I put my simplified version up here rather than going back a couple years where you have that. We do have a couple of pennants forming that Jeb shows on his chart and likely to see a breakout. Now, when we look at this, breakouts generally are in the direction of the current movement. And we've seen going back to what? April is when we peaked and have been seeing yields move lower, lower, lower. We are now in this lower channel. We hit the top of it and again appear to be moving back lower. We had a conversation today with Logan Mohtashami on the podcast that will be published next Tuesday, and he rightfully pointed out that 380 has been a sticking point. We have not been able to get below 380 on the 10-year and stay below it. We closed at like 375 today. It'll be interesting with the rest of the data this week if we can push lower. We're still going to have a sticking point at like 366, 365, and we haven't been able to break through 325 since rates started moving higher. So there's definitely some resistance as we move move down, but the trend is our friend at this point in time. Part of that discussion, Jeb, we had talked about the spreads between 10-year treasuries and mortgage rates. They had peaked up well over 3%, and we've seen some nice improvement. If you look at the right side of that chart, we've seen a nice little leg down. Hopefully we continue to see that, where the spread's at 2.5 today, and partly that was because the 10-year came down. The reason what you generally see quoted is the Freddie Mac primary mortgage market survey that comes out every Thursday, but it's 3 or 4 days out of date when it comes out. Fred has included, as of about a year ago, the Optimal Blue mortgage market index. So I have the spreads here calculated off the Optimal Blue index. And yesterday, rates were about the same as where they were today, but yields came down on the 10-year. So it pushed it back to about 250. Yesterday, we were in the low 240s, 242. And if you look at this chart, going back pre-COVID, well under 2.2 was the expectation, and 1.8 to 2% is normal. If we were to just moderate down to that 2.25, 2.15, you're seeing rates about 0.25% lower before we start even factoring in that move that we're expecting to see in the 10-year. So in terms of actual real interest rates, what does this look like? Mortgage News Daily reporting 6.38 on the 30-year fixed. It's generally well-qualified borrowers. What I like to look at this, little change over the day, little change over the week, little change over the month, but 0.7% lower than where we were a year ago. FHA at 5.76, VA at 5.78. And when you look at that, those are almost 1% lower than where they were last year. One of those data points, Jeb, that you and I talked about earlier today is that affordability is much better month over month or over the last 6 weeks or so. In the ICE market monitor, what they were pointing out is median priced home is $150 cheaper per month than it was just like 45 days ago. Mm-hmm. Now, it's still only 35% of households can afford that, which is about 10% worse than what we've seen historically. So it's not that affordability is good, but it is definitely improving and moving in the right direction. So with that, Jeb, that brings us to the beautiful red, white, and blue map.
Yeah. So the red states are where Josh himself can actually do your loan, help you. The blue states are where you would work with our referral partner, David. Either way, if you're looking to buy, sell, refinance, and you need help, you need guidance, that link scrolling in the bottom right now will get you in touch with us, our team, and we can guide you through that process. And actually, I went a step further here. This map, it's the same map. It's the same United States, believe it or not, guys. The blue states, what's highlighted in blue are states where I've actually referred a buyer to an agent who's closed a transaction in 2024. California, there's been multiple closed there. Nevada, Arizona, a couple closed there. Texas, multiple closed there. Some of the other states just had one, but green are all states that I've referred somebody this year, and they are still working with their agent to find the right property. So cover all 50 states, guys. If you need an agent, reach out. That link scroll in the bottom will get you in touch with me, and I can get you in touch with them. So, Josh, you brought up the probability for the Fed funds rate cuts rather. And one of the questions we often get is, hey, when they cut September 18th, which is the next meeting, are rates going to go down by X amount? Well, here's the thing. We took that question and made an entire podcast episode out of the Fed and what that means, what that Fed cut rate means. It posted this past Tuesday on the Educated Homebuyer podcast. If you don't listen to the podcast, go check it out. You can watch a video now, even if you're on Spotify, it shows a video. Apple, you still have to listen to us, unfortunately. But you get the, to know exactly what all of that stuff means, again, to make you educated homebuyers. Josh mentioned talking to Logan Matashami. So last time we talked to Logan was back in December of 2023. He gave us his prediction for what was going to happen this year. Today, we update that prediction, what it's going to look like going forward. He gives us expectations on, where he thinks rates can potentially go to some degree. And so, with the Fed meeting in 2 weeks and, what that plays out, where he sees things going, assuming we have the current trends with employment. So next Tuesday, it'll come out. It'll be here on YouTube on the Educated Homebuyer podcast channel. It'll also be online if you want to check it out. But anyway, that is it. Now we are going to talk some questions. We're going to answer some questions rather. So Josh, we got refinancing questions constantly. I'm going to start with homeowners insurance because you started off the show with homeowners insurance, and go with JoJo. How will the increase in homeowners insurance drive the buyer's market? Josh, is it going to have an impact? I mean, I saw a stat that Allstate just got the okay to raise premiums, I think 34% in the state of California. And it's going to happen in the next like 30 days. So people's premiums that are due, I'm assuming coming due, are going to get a 34% increase, something crazy like that. How's that going to impact buyer demand?
Let's again, that's speculation. What I can say is currently, as of today, and again, we don't have an open market because the insurance commissioner in California says you can only charge so much. But other states are a little bit more of an open market, and for us, it's not evenly distributed. The person we were talking about earlier in the show, they're buying here in San Bernardino County, Riverside County, and that's not an issue. That the house that they're buying is in the desert. It's not in a flood risk. It's not in a fire risk. There's zero reason why it would have a higher homeowners insurance. We believe, don't know this, I'm speculating that there may be some claims against the buyer is why he's having a high premium and having to go to a specific carrier. If you're buying in one of those risk areas, it has been high and it can impact the values of properties in those areas. What I can say is most of my clients in California and even in other areas, even in Florida, North Carolina, areas that I've seen that do have hurricane risk, wind risk, that type of stuff, they're paying more, but it's not an exorbitantly higher amount. I have seen certain borrowers or certain high risk properties paying what I look at and I go, that's just insane. We have a client looking down at San Diego County and where they would like to be is all of these high fire hazard areas. And they finally just looked at it and they're like, this is dumb. Why would we pay $400+ a month for insurance versus buying 30 miles away, 30 minutes away, where they don't have that same risk? So I think it will impact buyer behavior. It's going to impact values on certain properties in those high risk areas. But as a whole, the entire market and big impact, I'm not seeing that.
Got it. Good stuff. Question. So user 007 says, is it okay to go to an open house without an agent and ask the listing agent to rep you as a buyer? What's the etiquette in OC? So the etiquette should be the same anywhere in the United States. The answer is yes, you can go to an open house. A lot of agents are unfamiliar with the changes and what's required. You can actually go to an open house. You don't technically have to sign anything in order to go in the open house, although some agents are requiring you to at least sign. There's a open house basically disclosure that some agents are requiring you to sign. Other agents are not requiring it because it's technically not required. But nevertheless, getting back to your question, can you ask the listing agent to represent you? And the answer is yes, absolutely you can. The etiquette is no different than it was in the past. But here's what I would tell you. I think the idea is that by going to the listing agent's going to do it for free. I don't know that to be the case. Now, compensation, everything is negotiable. So I would love to know what you find out when you have that conversation. Come back here and let me know what the listing agents that you've talked to have said when asking them to represent you. You don't have to tell me the fees, but just, I would love to know the more people we talk to. I mean, I know what some people are doing. I don't know what everybody's doing. So the more opinions we hear or the more, facts we hear, the better off we all are, right? The more educated we become. Josh, we've got a couple questions on refinancing and waiting and doing different things as we do every single week. You and I were talking prior to the show. We both believe that mortgage rates are going to continue to move lower. Is that immediate? Is it going to happen in September? Is it going to be October? Is it going to be January of next year? Hard to say. But the idea is that the trend that's happening now will continue. So we've got VA asking the question. I have 6.5 as of last month. Should I refi after the Fed or wait until next year? I can get 5.75 at a $2,500 cost. So that's one question. And we could just roll right into it with Jimmy J asking, he's at 6.25 right now, and he's hoping to refinance by the summer of 2025. So take that how you will, how you want.
Let's take it in pieces. So should I refi after the Fed or wait until next year? I have, and I think there's actually a version of
I just closed my refi today, Josh. It closed.
So you just closed yours today, but let's look at this. RM22 says, should I wait to lock my interest rate until after the Fed meeting, or is there risk of rates going up? Let's look at what did Jeb say 5 minutes ago? Hey, go listen to the episode. We did an entire episode. The market is not looking at the Fed. The Fed is not going to change your mortgage rate. The data over the next 2 weeks is what the bond market is going to use to price in future expectations of inflation, economic activity, and to a degree what the Fed is going to do. The Fed does not dictate your mortgage rate. The Fed, if they cut 50 basis points, are rates going to drop 50 basis points that day? They are absolutely not. They will likely improve. There could actually be a knee-jerk reaction to the opposite side. Let's say we get a really weak jobs report. Well, then rates are going to improve because they're going to expect the Fed's going to cut 50. And then we get a really soft CPI that comes in lower than expected next week. Then the markets will go, oh my God, rates are absolutely going lower. The Fed's absolutely doing 50, and they're going to price that in. They're not going to wait and go, hey, this is really good data. Let's see what the Fed might do with this. So they change on a daily basis. So what I would say, if you are in escrow, I've got about 3 clients right now that are floating. I have no problem with floating. 2 of them floated with the thought that I want to get to the other side of the Fed meeting. I mean, the Fed meeting is irrelevant. The things that are happening that are pushing rates lower, as long as they continue, then you're good to float. What I would say to them, what I would say to you is, under what circumstance would I lock? What would have to happen for me to go, oh my goodness, I'm no longer comfortable floating? It's super easy when day after day we go, well, it's a tiny bit better today. It's a tiny bit better today. It's a tiny bit better today. The reality is we've seen about 30, 40 basis points of improvement, I think closer to 30 the last 2 days. And you go, what does that mean? 30 basis points doesn't even move the interest rate 1/8%. So you need about 50 basis points to get you 1/8%. You need about 100 to get you a 1/4% move in your mortgage rate. So for most people, if it makes sense when we're opening the transaction and we're looking at 21 to 30 days before you close, the market is not going to move enough for you to absorb that level of risk. Now, what I will say is we do think in terms of counting the cards right now, it looks like the shoe is in our favor. So if you're a bettor and you're comfortable with it and you're comfortable with that risk, now is the time that you would be comfortable with it. But bigger question, all of these people saying, well, should I refinance? Should I refinance now? Should I wait? Here is what we're going. I'm going to go through. I've told people in the last week, I've opened refinances in the last week, and it makes perfect sense. I have told people, hey, you need to wait, and it makes perfect sense. If you have a smaller loan, if you have a smaller percentage savings, you probably want to wait and see if you get the opportunity. So one gentleman in Las Vegas, listener to the show, $300,000 loan. And he could either pay points, a bunch of costs to get it down like 1.5%, which would have saved him $250 a month, but it was going to add $12,000 to his loan. That was what a call center loan officer that had reached out to him had told him to do. When we run the numbers of what a 0 point, close to no cost loan was, it was going to save him $100 a month, and it was going to add about $3,000 or $4,000 to his loan. He's like, why would I do that? If we think rates are going lower, let's wait till I get that $250 savings without adding anything. Same token, though, I've got clients right now that we can save them $600, $400, $800 a month. We believe rates are going lower. We don't know that to be a fact. You don't have a crystal ball. I don't have a crystal ball. So what does that mean? If at low to no cost, you can lock in a significant chunk of savings right now, go ahead and do it. And then know that, like Jeb did, and we're going to watch this. And in 6, 8, 9, 10, 12, 18 months, probably going to be another opportunity to do it again at low or no cost. What I do not want to see people doing is going, hey, I'm at 6.75. The 0 point rate today on my new FHA is 5.75. But if I pay 2 points, I can get it to 5.25. Well, 2 points on a $400,000 loan is $8,000. That additional 0.5%, you're talking 5-6 years before you would ever recoup that. You're going to most likely get an opportunity to refinance well in advance of you ever recouping that cost. So, we've got a couple of questions here, Jeb, that sort of relate back to that. And again, it just really just becomes the refinance show here.
Yeah,
but
let's
Crown
move
Clown,
along. Yeah,
Crown Clown pops in and says, I just got a loan with buying 2 points at 5.2 for a $550,000 house. Why would you pay points that have a 5.5-6 year break even period unless you're looking out in the future and going, this is the lowest rates are ever going to get? There's really only 2 reasons to pay a bunch of points on the loan: is that you are going to lose your ability to qualify, meaning you're going to retire, you're going to lose a job. Something is going to happen that's going to keep you from doing that. Or you think that this is the best rates are ever going to get, and you want to lock in that super low interest rate. Neither of those for most people appear to be where we're at in the current market.
All right. Staying on refinances, we're going to move along here. Love for Puppy says, do refinances trigger an early property tax assessment if your home increases in value? No, they do not. Nothing changes on that front. Jay Homeboy, if I haven't broken even on my refinance, should I consider doing another refinance? Can refinancing a second or third time speed up the time to break even? So Josh, not the same question, came in a different way. What are your thoughts on it?
This is a really easy question. Today, I have the opportunity to save more money, but I haven't recouped the cost of the last loan. Should I save less money and wait until I recoup that cost and possibly miss the window to refinance? Or should I just do it today? The most important thing, again, is going back to this. We want to keep those recoup periods at like 6 to 12 months. So I'm not against you paying some costs for your loan. We don't want to pay a lot of costs for that loan because there's a very good chance that 6 months, 12 months, 18 months, 24 months down the line, you're going to want to do this again. Now, if you have a $200,000 loan, $150,000 loan, you're in a great situation that it's a smaller loan. You have a much smaller payment, but that hurdle to make it make sense in terms of how much you need to save in interest is bigger. And the costs as a percentage of that transaction are much larger. So it's a more difficult calculation. What I would say, here's the most important part. We get this question here online. We get people calling from the podcast. And 9 times out of 10, these are people that are working with a loan officer. Here's the answer. If your loan officer can't pull out a spreadsheet, I don't mean crank one out on the fly, because we talked about that last week where they can tell you anything with the spreadsheet, but a system of comparing 2 tools, 2 options, current loan, low to no cost loan, you paying a bunch of points, and walk you through that so that you understand, feel it, and can make the best decision for you and your family. Don't work with that loan officer. Like I'm frustrated in that we talk all the time on the show, Jeb. It's 80-20 industry. 80% of loan officers are worthless. Even of the 20%, 80% of them are fairly average. So you want to be working with one of those top 4 or 5% loan officers. I talk to listeners to the show, the podcast, people who find my podcast, my videos, and they'll reach out and I'm like, why are you working with this? Why are you asking me this? Like, why did you get to this point? If you have that little confidence in the person that you're talking to, find someone new to work with.
There you go. We're going to break up the refinance show here for a moment, and we're going to just get some blessings from BB. They're sending blessings from the Villages in Florida. Nice retirement community down in Florida, golf courses. They got everything. They don't even need to leave, Josh. You can play golf. You could probably play pickleball. You can go hang with your neighbor. You could, entire community, just all the same, just loving life down in the Villages.
Barb was here with us here in California, and she said, I'm done with it. She rented the house out in California. She went to the Villages and says, I don't even need to leave the village. I can golf cart
good
around.
For her. I wish
thing.
I was there with her. Well, not with her, but that gets weird, guys. Matt is saying, love the show. First time able to catch it live. Keep the great info coming. So thank you for the support, Matt. Brian has an interesting take on the question a moment ago about going directly to the listing agent. So Brian obviously is an agent himself. Says dual agency is not good. If a buyer can come to my listing and ask me to represent, I would tell them to get another agent. I cannot represent both as a realtor. There is definitely a gray area when it comes to dual agency, or dual agents rather. Dual agency is the same company representing 2 buyers, which is always going to be part of the business because, you have some really big brands that have a lot of agents, and it's impossible sometimes to not have an agent if you're in a smaller marketplace working for the same company. But my belief is dual agents will be a thing of the past in California within the next couple of years. I think that is step 2 of the changes that are going to happen. My personal belief, I don't know that to be fact, but it is a gray area, and it is something I have benefited from it many times in my career, but it is something that I believe should be not. I don't think you should be able to do it. It's like, Josh, it's hiring the same attorney to represent you in a divorce situation. It's any of the same things. It's just a weird deal.
That's the best example, because what it is there's no negotiation at that point. It's mediation. That realtor is no longer your advocate. At a best case, they're going to be sitting there between the 2 parties and go, how do we split the difference and make both of these people happy? I'm not saying that I want an adversarial relationship where they're fighting and cutthroat. We do want to cooperate as much as possible, but I want someone representing me in my best interests. So if we say, let's say that, I mean, 6%, especially for us in Southern California, hasn't been the norm for a long time. If it's 5%, split equally, 2.5, 2.5, how much are you going to save? Are you going to get them down to 3%? So a 2% savings, some of that is going to be passed along to the seller, some of it passed along to you. So for the most part, a 1% savings on the price of that home is about what your likely max savings are. Do you think that a good negotiator working in your best interests, even with a good negotiator working in the seller's best interests, that we might not be able to get a better deal and at a minimum give you greater peace of mind that would be worth that cost? I always just tell people exactly what you said, Jeb. Do you want a mediator or do you want an advocate on your side?
Absolutely. And again, some people will choose the mediator just because in their minds it's the deal and whatever. But again, I've come across many situations in my career as an agent where if I were representing both sides on the, I wouldn't have gotten the repair requests. I mean, I've gotten some crazy things through as an agent that I guarantee you, if you're representing the seller, it's a tough thing to ask. And it's a tough thing to represent two sides in doing that. But anyway, do what you feel is best for yourself. Maria's got a question, says, if your spouse passes away and they were on the loan, do you have to inform the bank? What happens if you do or if you don't, Josh?
Nothing. It's a secured debt. The bank doesn't care. I hate to say that because it sounds a little cold when we're talking about someone passing away. The bank doesn't care. Either someone is going to make that payment on a monthly basis, or they're going to come in and basically foreclose on that property. So no, they don't care. What you would want to do is make sure that you record a death of joint tenant deed if your joint tenants, whatever the appropriate deed is, to record into the chain of title with the documentation showing that that person has passed away and that you are the sole owner. But it's not going to trigger any, it wouldn't be due on sale. It's not a due on death clause in mortgages. So you're not going to have that issue. The one exception would be, and I don't think Maria is this old, if you have a reverse mortgage on the home, there can be an issue with that. As long as it was originated properly and everyone signed the right disclosures, you can stay in the home past the death of the first person. But it would be really, a reverse mortgage would be the only situation where you would want to actually ask this question.
All right. We've been on 36 minutes, guys. I just hit 111,000 subscribers on my channel, and I want to say thank you guys for doing that. If you haven't subscribed to the channel, want to stay updated on everything mortgage and real estate related, do me a favor and hit that subscribe button. If you're finding any value in the content tonight at all, you like Josh, you like his haircut, you like his hat. A lot of people like his hat. Give us a thumbs up. Let us know, and go check out the Educated Homebuyer podcast if you haven't done that already. A lot of good content on that side. And a lot of in-depth content to really keep you going. Maria has a follow-up question here that's really easy to answer. She just says, is there a free of charge website where I can check to see if my property has a lien? So Maria, I'm not aware of a free website. Just call your agent. Your agent can, get a title report ran and get it checked to see what kind of liens are on title. Outside of that, I'm not sure of any site that you can actually go to and pull that information. Otherwise, it would, it kind of puts people in weird positions when that's public data. So I don't think that it's public, but hard to say. Okay, Josh, we've got a couple here. We got on refinancing. I'm trying to stay away from refinancing. It's going to be really difficult, actually.
No one could refinance for 2 years. So now there's a volume of people.
Well, no, that's fair. So Krishna says, is there a minimum time to refinance, a timeline to refinance after your home closes? So Josh, this is something we get all the time. What's the answer?
There are seasoning requirements to use a new value. So if the home went up in value, which we're not seeing as much, but during COVID, people would buy and 6 weeks later, it's worth 10% more. And they go, hey, can I refinance, get rid of my mortgage insurance? Can I refinance, take cash out? There are requirements in terms of the seasoning, but just of you saying, can I refinance to a lower rate? There is no limitation on you except for some types of non-QM loans, DSCR, bank statement loans that may have a prepayment penalty on them. But all of the loans that we're talking to you guys about here, FHA, VA, USDA, Fannie, Freddie, they're not going to have a prepayment penalty. But what there is on those loans is an early payoff penalty to the lender that did your loan. So if you pay off within 180 days and you did a 0-point loan, the lender made money. I do 0-point loans all day, every day, but we still make money. We earn on that. But what happens is if you go 6 weeks later, 2 months later and you pay off that loan with a new refinance, we have to pay back everything we earned. So all that we ask, we have a bunch of people that have bought over the last 6-8 months, and they're in a position where we need to consider refinancing. All the questions that you guys are asking, do we do it now? Do we do it in the future? We probably want to just continue watching rates slide down, and we can probably get a win-win where we can get me past that 180-day EPO and get you a lower interest rate with bigger savings than what you would realize today. So just hopefully you had a good experience with your lender. If they were terrible and flaked on you and gave you a bad deal, then feel free, go and stick them with an EPO. But if they treated you well, at least give them the opportunity to walk you through that information, guide you through that decision of, do we have to do it today or can we get to 181 days?
All right. So here we're going to do something different tonight, guys. I'm going to put a question on the screen. I'm going to read it. I want you to answer the question on our behalf to see if you guys have been listening over the last 4 years, because this is a question that we get, not picking on Jose, but it's a question we get all the time. And
we don't even know if Jose's been here before.
I want to test the knowledge of our audience to see if they can answer this question. What percent lower does the rate have to be in order for it to be worth it? 1% question mark. So how does someone, I guess this is a better way to put the question, how does someone know how much they need to save in order to make a refinance worth it? Let us know in the comments. We'll read it in just a moment. We're going to come back to that one. Josh, somebody's asking about a HELOC. So a HELOC is a loan. It's a second loan that typically comes after your first. There can be first HELOCs, but the question here is, would a HELOC affect my 2.9% rate? And should I do one to wipe out the 30K? So the second part's not irrelevant, but I guess the first part of the question is something. When you get a second loan, does it affect your first rate?
No, not at all.
Yeah,
so
exactly.
quick and easy answer. Probably to give you a little bit more information on this, if you're looking for a $30,000 loan, I'm a mortgage broker. People will reach out and they say, can you do a HELOC? I can absolutely do a HELOC. If you want a $30,000 HELOC, there's no way for us to profitably do that, or any other independent mortgage lender. So what you need to do with that situation, go to a credit union, go to a local bank and see if the way they're structured that they're able to do that, or if they have a minimum size. Most of them will go down to at least $25,000, but don't be surprised if they tell you, hey, we need to do a $50,000 line there in that situation. So just don't, if you do have to go to a slightly higher amount, make sure you don't use it if you don't need it.
Good stuff.
We got no answers. No one has answered.
No one knows
accurately.
the answer. So we're going to save it till the
No
end.
one knows
because
the
I
answers.
feel like it's one of those things. Moneybags is asking if their question is going to get answered. So Moneybags, if you showed up every week, we answer this question every single week as well. Are rates going to head back into the 4% range in the next 18 months? We don't have a crystal ball. So impossible to say whether it's going to happen in the next 18 months. But what I will say is that employment's likely to continue getting worse. The economy is going to continue slowing. Rates are likely going to continue moderating. Does that mean a 4 handle on rates in 18 months? I don't know if it's 18 months, but I think probably within the next 2 years or so, you see rate with a 4 handle on it. Could it happen in a year? Sure, it could. But I think it's very hard to predict at the moment without seeing some of the data lining up.
So Jeb, let's look at what would have to happen. This is the way I like to answer it. Don't know if it's going to happen, but what would have to happen? So Jeb mentioned the things that are going on in the economy. Yep. You need the 10-year down to about 2.75. You need the spreads between 10 years and mortgages to be back to about 2%, which it's remained above that for periods of time. We had about a 30-year period where they were well below that, but 2% would be aggressive to see in the next year or two. So your 18-month period, I think 2.75 is an aggressive move down in the 10-year, unless the economy gets even weaker than what most people are seeing right now. But that would get you a 4.75 30-year fixed rate, and that would have FHA and VA loans at about 4.25. And I think most people in the current market, that would be amazing. I would love that. That would give me the opportunity to get into the market.
Well, good stuff. So hopefully that helps you out. I mean, the reality is it's going to happen. In my opinion, the question is, how long is it going to take to happen? I don't know. I'm still a firm believer that you see an interest rate with a 5 handle on it by the end of 2024. 5.99, 5.75, 5.5, 5.25. I don't know what the number is, but I think there's a 5 in front of it by the end of this year. There's 4 months to make that happen, and data lining up.
Jeb, we have a winner. We have a
winner. Do we have a winner? Let's see. Ooh, here we go. Barry May. So we're gonna put the question back up here again. Read it one more time. And then we're going to give Barry's answer. So what percent lower does the rate have to be in order to be worth it? So that's going to depend on your loan amount. Okay. So it's very difficult. So for the higher your loan amount, the less the rate you need, the less you need to go down in rate in order for the refinance to actually make sense. So Josh has a theory that that Barry is mentioned here. So Barry's been listening, obviously, where everybody else has been just looking
studiously
at our
listening,
just pretty faces on the screen. They just thought we were here, just putting wisdom out there in the air. We didn't want them to retain it, but Barry says take $125,000 and you divide it into your loan amount. So Josh, if my loan amount is $250,000, how much would I need to save?
0.5%.
0.5%. That's good math. Josh, if I have $1 million loan, how much do I need to save?
0.125%.
All right, Josh, if I have a loan amount of $7 million,
like nothing, any move lower in rates makes it make sense.
I like that.
So I'm waiting. There's gonna be the what about, what if, this, that, and the other. So we talked earlier in the show, the guy in Vegas, $300,000 loan, he was going to save 0.5% if he did a 0 point close to no cost loan. And for him, it was like $100 something savings a month. He's like, that's for the birds. I don't want to do that. So what someone was trying to sell him is, hey, we can get you a percent savings. So a $300,000 loan, percent savings, you should do it, right? 125 against that 300,000 says anything more than 3/8 makes it make sense. Well, in his situation, it was going to be $15,000 of fees, and it was going to save like $250 a month. He's like, no, that's for the birds. So all of the other things that you guys are mentioning are still accurate and valid. So when we say 125 divided by your loan amount for a 0 point low cost loan, it's not adding a bunch of fees back in. Several of you mentioned something that's really, really, really important. Every call center loan officer in the world is going to tell you, hey, you got a 30, here's my 30 year today. But you might have been in that loan for a year, 2 years, 3 years, 5 years. So the correct comparison is to a 26-year loan, a 28-year loan. So all of those things come into play. The rule of thumb is just that. It's for you at home to take that number, do that calculation and go, hey, Mortgage News Daily says rates are 0.5% lower, and my $300,000 loan says I need to be 3/8 lower. Let me call someone like Josh and run through the numbers, see what it would actually cost, what my monthly savings is, and make that decision. Most people, when you hit that number, will go, oh, heck yeah, I like that. That will make sense for me, and I will go ahead and do that.
Yeah, and it's not going to work for everybody. So in this case, he's got a $465,000 loan, Josh. So
it's about 0.25%.
Not quite 500,000, but he's at 6.9. So today seems reasonable that it would make sense to refinance. Being rates are at 6.25, 6.3, whatever, somewhere in that ballpark. But again, cost fees are a major piece of that puzzle. Loan term, all of those things. So just make sure you're talking to a pro and not some clown off the street that is just scraping for his only loan of the month. Here's another question. Says, if I have a rental property and collect rent in cash, does that hurt you when you go to refinance your primary residence? So the easy answer is no. It really comes down to how you file it on your taxes. If you report it correctly on your taxes, the amount that's coming in, doesn't matter how you receive the money. But most people, when they're receiving cash, don't report anything on the taxes or report it differently than they actually receive, which now, if I'm correct, Josh, that will actually impact your ability to qualify.
Yeah, the only time that we ever really want to prove receipt of the rents is, let's say you bought a house in January, and a rental property in January. So it never showed up on a tax return before. And now you're trying to get another loan in December or even January the next year. You haven't filed your taxes. So we don't have a tax return to look for you to tell the government I earned $25,000 in rental income. So we go, well, get us a lease. Okay, the lease says you get $2,000 a month. Now get me 3 months, 6 months of bank statements and show that you're receiving that $2,000. And if it's a cash deposit, that's going to be a little bit difficult. If it's a cashier's check, it's going to be a little bit difficult. So I would suggest that you make sure you get a real check or a Zelle or a Venmo or something that can be tied back to the same payor every month. In the short term. In the long run, Jeb's 100% correct that it doesn't matter. What you report to the government is what we're going to use in terms of qualifying income.
All right, good stuff. So with the topic of refinancing, I'm just going to be transparent, right? And many of you guys know this who watch the show, but I'm going to lay out kind of my scenario. So last November, I bought a house. At the time, rates were higher, and I did a 7-year loan. Why did I do an ARM? I did an ARM because I believe rates are going to continue to move lower. Not worried about the rates adjusting, so on and so forth. I'm familiar with the process, all that good stuff. So I took a rate of 7%, I think, at the time. Fortunately, I was able to, rates came down early in January, into December, January, and I was able to refinance at that time to 6.5%, doing a no-cost refinance. So no cost in the sense that, in this case, the lender, being completely transparent, was charging me a small origination fee, a small processing fee. But with the rate that I got, they actually gave me a credit to cover that, as well as part of the title and escrow fees, the closing costs that were associated with it. All I had to pay was prepaid interest and what you would normally pay on your mortgage. Able to refinance to 6.5%. So I've had that 6.5% for the better part of 7 months, 8 months, at which point rates went down about 4 weeks ago, Josh, or so. We got some news out there with the yen carry trade. I think some data was better than reported out there, and rates dropped. Was able to lock in 6%. So I went from a 6.5 to a 6%. So within a year, I've gone from 7 to 6.5 to 6. I could have waited until rates got down to 6, but each time I've done this, I've saved about $400 based on my loan amount. So I've saved $800 in 2 different refinances, coming with no money out of pocket, right? In a no cost refinance. So the reason I bring that up is people say, hey, should I do it now or should I wait? If it makes sense to you, like if you understand the numbers, lock it in while you can. And then when it goes lower, take advantage of it later. Now, there are some scenarios like Josh mentioned where, your employment's changing, you're doing different, maybe you're retiring or whatever, and you're just not going to be able to qualify and you want the absolute lowest rate. There's a chance that rates go lower again. And I think that's going to happen. Is it going to be a month or 2 months? I don't know, but you have the ability to wait, but there's also, take the opportunity when it presents itself. So I did not, another question, did I need an appraisal each time? The very first time I did not. The second time I did. So I needed an appraisal the second time. The first one was so new that I didn't need it.
That's interesting, Jeb, because it is unique. It is a portfolio loan. So he who holds the gold makes the rules. So whatever they say the rule is, but generally an appraisal within 12 months, you can get what's called a recertification of value. They engage the same appraiser to just certify, I researched recent comps and this home has not decreased in value. So you're not getting any additional value, but they can generally certify that homes have not decreased in value in that area, and that will be accepted.
It was also surprising that the loan to value too. It's not like it should be an issue, but nevertheless. But anyway, that's my 2 cents on it. I know a lot of people are asking that question, so I thought it would be just kind of a way to kind of let you know my scenario. So Omar says, what is the minimum down payment for an investment property? So Josh, a lot of people out there have a belief, hey, I'm going to go buy an investment property and I'm just going to do the same thing. I'm going to put minimal down or what have you. Is there a different down payment required?
So single family is 15%, and you get to 2 to 4 units, you're looking at 25% down for your Fannie Freddie stuff. VA, you can't buy an investment property. FHA, USDA, you cannot buy an investment property. So really we're looking at Fannie Freddie or portfolio options. So there are some portfolio lenders out there that will do them with less down. The terms are going to be much worse. So unless you're getting a monstrous discount on the property, you've got a rich uncle that's selling you $1 million place for $500,000. Those numbers are probably not going to make sense for you. You're going to need to do that bigger down payment. So kind of goes back to, for our audience here, most of you guys are first-time buyers. Maybe you own a home, you're looking at buying another property. When you're going in to buy your first property, if you want to acquire rentals over time, the best and easiest way to do it is do a minimum down purchase of your own residence, live there for 2, 3, 4, 5 years, go buy that move up home as your primary residence. And now you have a rental with that original lower rate, owner occupied, lower down financing. It's not perfect for people who are looking to add properties later on down the line, but if you have a game plan going in, it is far and away the easiest way to make it happen.
All right, good stuff. Maria is asking another question here. Says, do you think realtors will agree to just write up an offer and negotiate on open houses? You went yourself for a certain fee, since sellers are not obligated to pay buyer's agent. So to be clear, sellers were never required to pay a buyer's agent. I feel like I have to say that every time because it's like this new thing that, that it's just It was never required. Nevertheless, do I think that will happen? Some agents will work like that. Yes. Will all agents work like that? No. You're going to see a lot of different things happen because this is so new, because people, do it different ways. I will tell you, I mean, here's a scenario. I've written 3 offers with this scenario changed. The first one, I wrote the contract. My buyer agreed to 2.5% compensation with me. I wrote it as part of the offer for the seller to pay it. The seller countered back at 2%. We agreed to it. My client agreed to that. And I just basically went back to my client and said, let's just modify the terms to 2%, and that'll be good. So I took 2%. She was willing to pay me the additional 0.5%. In this case, I said, don't worry about it. Let's just move on. She agreed to the contract. So in that case, I negotiated my term lower in this case, and we went forward. I had another scenario. This offer did not get accepted, but it was a cash offer. And so in a cash offer, the buyer's paying your commission regardless of your compensation, regardless of how you look at it, because it doesn't matter how it's done. It's either in the price or it's coming out of their pocket. So it's essentially the same. In this case, we wrote the offer to be X price with the buyer to pay compensation directly to Jeb. So in that case, we weren't even asking the seller to pay it because it was a cash offer, and the net is essentially the same to the seller. Okay. And then I have one at the moment where I'm not representing this. I have the listing on this. Just got the offer a moment ago. Where the agent has agreed to a lower compensation fee. So my client is actually willing to consider compensation. Okay. The agent knows it. We've talked about it. Instead of them asking for compensation, they're actually just going to write a little bit lower purchase price and allow the seller to keep that compensation so that the net is higher to the seller, and they're going to pay their agent outside of escrow. Okay. So you're going to see a lot of different things. You're going to see a lot of that scenario. You're going to see people do it different ways. You're going to see people that aren't willing to negotiate because, hey, this is my fee. This is the way I do business. This is X. So I think 3-6 months down the road, we'll have a lot more data. We'll be able to see what people are doing. And we're able to report this in the multiple listing service. So if I pay compensation to a buyer's agent, we put it in the MLS when it closes. So you know exactly. So you're going to be able to go and pull properties, compare what people have done, and get a really good idea of what, is happening in certain areas and what people are doing. So I know that's a long-winded answer, but I think, there's a lot of confusion around it, and it will all work out. I promise. Josh, does the 15% down, the 25% you mentioned earlier, does that change if it's an owner occupied investment? So say it's a 4-plex, you're living in one, you're renting out the other 3. So technically an investment, is that considered an investment or is that considered owner occupied?
Owner occupied units, we had a change here in the last year. So Fannie Freddie will allow you to do 5% down. I've not seen very many, if any of these closed in our office. I haven't closed one personally, just because when you look at it, you get all sorts of add-ons in terms of the rate. You have higher mortgage insurance, makes it difficult for it to cash flow. Now, FHA and VA, and I believe USDA, but FHA and VA will absolutely allow you to do minimum down. So 0 or 3.5 for VA and FHA. In terms of the units, they just all differ in how they're going to calculate the rents and what you can add to your income for qualifying purposes.
All right, good stuff. Sorry, Josh, I just snorted into the microphone there. We don't have a lot of questions, guys. So with that, if you haven't hit the like, subscribe, do that. Help us out. Help us continue to grow the channel. Help us continue to educate buyers, sellers like you. I want to ask another favor. Success stories. If you've closed on a loan and you're here listening, let us know. Let us know a review. If you've closed on a property we referred you, let us know. I mean, these are all things we want to know. It's one thing to come out here and talk every week and educate and whatever. And yeah, that fills the bucket, the education bucket that we're trying to fill. But the success stories, that's really what keeps this stuff going. That's really what drives the passion to continue to want to do what we do, right? I mean, I can say that, I like you guys. I like Josh. But I'd rather be watching my kid practice right now, football. It's something at some point, I'm not going to be able to do that. Right. But rather we're here doing what we're doing because we want to give back, want to provide value. So let us know if we can help, if we have helped, if we can help. There's a link scrolling the bottom. it definitely works. So BB is actually working with Josh. So you didn't tell me. Oh, that's how you knew Barb's situation?
That's how I know Barb's situation. Barb and I have been
Gotcha.
talking for years now. She was planning before she made the move.
All right. Good stuff. Well, Classic Eddie. Classic Eddie. What are rates for investment properties right now, Josh? Say you're gold-plated borrower. You got perfect credit. You got the debt 25% down, 30% down, buying a single-family home. What do rates look like?
That gold-plated borrower with a nice chunk of equity or a nice down payment is going to be in the high sixes. We do have options that are really, really good. That being said, if you've got a 680 credit score or a 710 credit score and you're looking for 20% down, it can be ugly, still well up into the mid sevens.
No, good stuff. So been on here an hour, guys. Show up every single Wednesday to educate you. We'll be back here next Wednesday. Next Wednesday is a big day in many ways, because by next Wednesday, we have payroll data, which comes out on Friday. We'll have ADP and claims tomorrow, jobless claims tomorrow. And then we got CPI next Wednesday. So between now and next Wednesday, you have the potential to see the rates actually move. Are they going to move a percent? Probably not. Could they move a quarter? Could. You never know. A lot of it has to how much of it's front loaded is the real question. But we will see. So Josh, what would you like to say as we exit this evening? What wisdom would you like to bestow?
I will make a request. We've talked for the better part of the last year. You want a second opinion? You want us to look at numbers? Let us do it. I talked to a ton of people, not super happy with the process and the way that it's going. Let us be your first call. If you've been here, you've been watching, you've enjoyed the content. I'm biased, but we do have a very structured process for getting you accurate answers, the answers that you need, and all of the knowledge and information to make informed buying decisions. So if you're in the market today, if you're thinking you'll be in the market 6 or 12 months from now, I'd love to talk to you and go through that. And with all these refinance questions, these are the questions that I'm dealing with all day, every day right now, and helping people quantify. Does it make sense? Does it make sense to do it today? Does it make sense to wait? So if you want someone to walk you through that information, we're happy to do that for you.
All right, guys, until next week, buy right, borrow smart, build wealth.